Certain areas of the economy are showing signs of a slowdown. We just went through an earnings season where multiple companies were unable to meet what the analysts' expectations had set out for them. We're starting to hear a little bit about layoffs. We're starting to hear a little bit about the consumer not spending as much as they had in the past. And that brings out talks of a recession. There's a group of people that thinks we're already in a recession right now. There's another group of people that think 2023 is going to be the year. To be completely honest with you, I do not know when, if, how, anything about when this recession is coming. But what we are going to talk about today is an indicator that I use to take a look and see what the underlying health of the economy is, and it does have some past history of predicting when a recession will come. But if this is your first time here, my name's Nick. Welcome to Waste of Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. Every single Sunday, we put out content similar to this. So come back, come enjoy the videos, especially if you like this type of content. So we talked about it in the intro. The recession indicator that I watch the most is the difference between the 10-year US bond and the 3-month US bond. Now, I know a lot of people take a look at the 10-year and the 2-year, which has definitely been a good indicator. But the reason that I like this the most is it's had some accurate depictions of when a recession is coming. We'll start out by taking a look at the chart, and then we'll explain it a little bit further as to why this is a good indicator. We can take a look at this chart. The data only goes back to 1982 up until present terms, and it's calculating the difference between the spread on the 10-year bond and the spread on the 3-month bond. We'll discuss a little bit further about why this is important, but basically the closer it is to zero, the worse it is for the economy. So we can see in the chart, not only are the lines, the spread indicated in blue, but you also have gray shaded areas, and those are areas in which the economy went into a recession. So we'll start in the late 80s, heading into the 90s, and we can see that this line dropped below the zero number. And followed by that period, we saw that the US economy and essentially the world went into a little bit of a recession in the early 90s. We followed that up again into the 2000s. This is the tech bubble, and we went super negative for a certain period of time. And we can also see that that had led to a period of a recession. Again, in the 2008-2009 financial crisis, it was a precursor warning there. If we can see, it started to go negative in 2007. So this definitely was a little bit before that financial crisis. So almost a pre-warning. We can see the drawdown there lasted for a particularly long time. Again, it dropped in 2020 due to the pandemic. And then now, if we zoom in a little bit further, we can see here that the line went negative again, and that just went negative towards the end of October. Now, we do see a little bit of that line coming back up to zero, which is a good sign. But the fact of the matter is that we're in that territory that we need to start watching. We need to start taking a look at this to see how healthy the economy is. And I think what is important to note is that this needs to be negative for a prolonged period of time. I believe the number that people start looking for is 3 months or 90 days. So explaining why this is important, let's take a look at why a flat yield curve is a bad sign for the economy. We can see here a flattening yield curve may be a result of long-term interest rates falling more than short-term interest rates, or short-term interest rates increasing more than long-term rates. A flat yield curve is typically an indication that investors and traders are worried about the macroeconomic outlook. So as an investor, if you can get the same yield for a short-term bond and have that bond be a little bit more liquid, there's no point investing your money for a long period of time. And this is happening when the Fed is tightening. So when they start to increase the interest rates, that's when you start to see this effect take place. And that's where the macroeconomic outlook comes into play here. And obviously with inflation ramping up and being maybe over that percentage, why would you want to lock in your money for a 10-year period? So this is a very high level overview as to why this is an important metric that we're looking at right here to see what the underlying economy is doing. And right now it's showing definite signs of weakness. Again, I do not know when, how, if ever the recession is going to come into play. These are again just indicators. We don't know what's around the corner. I wouldn't make any, vast moves or move anything around in your portfolio to go with this. This is just giving you signals to show you what the underlying strength is. So let me know down below if you've ever looked at the 10-year versus the 3-month spread on a US Treasury. And, throw a comment down below if this is the first time you're hearing about it. I appreciate all your support. I hope you all have a great week in the markets. Happy trading.